Canada is known as safe and stable country, but what if the stability is hiding some big problems behind it? What if Canada's growing debt could actually trigger some serious crisis? In this book, How Countries Go Broke by Ray Dalio explain the warning signs, something he calls the big debt cycle. So today, let's see, could Canada be on that path? What would need to go wrong for this to happen? And how real the risk is. By the end of this video, you will understand the dangers, what to watch for, and the choices Canada has ahead. Hello everyone, my name is Parth Soni. I'm a realtor based in Ontario. If you like this kind of content, do follow and subscribe my channel. So first, let's define what going broke means. Now, Dalio doesn't always means literal insolvency or bankruptcy. Instead, what he means is a collapse in the ability of a government or a country to meet its financial obligation in a stable way. Skyrocketing debt service, loss of confidence, inflation, maybe a default, or maybe external intervention or restructure. All this considered under this. Now, to understand this, we need to understand the big debt cycle. And the key component of Dalio's big debt cycle is number one. The very first one in this is the excessive borrowing, both by government, household, and also on the corporate side. The second in this one is the debt service burdens rising. It is interest payment becoming a big fraction of revenue or incomes. The loss of competitiveness or productivity. You can't grow your way out of this easily, and this is something we will discuss later on in this video. The fourth on this one is the fiscal policy stress, like printing more money, devaluation, inflation, and things like that falls under this bucket. Last one on the list is the confidence meltdown. Now, this could be like investors, citizens lose faith in the country, borrowing costs could spike, rise of default. Now, let's look at Canada through this lenses. Now, here are some of the hard numbers as of right now, and all these numbers are from legit website. Now, according to Debt Management Strategy 2025 and 2026, Canada's total market debt is projected to reach 1,619 billion by the end of 2025-2026. And over here, if you see, this is again the screenshot from Canada.ca official website. If you see 21, 22, 22, 23, it says all the debt in 21 and 22 fiscal year, we have a total market debt of 1,232 billion, and the projected for 2025 and 2026 is 1,616 billion dollars. Now, Fraser Institute reports that combined federal plus provincial net debt to GDP is expected to rise from 65.9% in 2020 to 74.8% in 2025, and that is a big jump in just a couple of years, and that's a big increase in a short time. Now, what does this mean for everyday Canadian in a normal language? So, a higher debt usually means more on your tax dollars will going towards the interest instead of healthcare, schools, or tax relief. If the debt keep rising in this manner, the government may have to raise taxes, cut services, or even have to borrow money from outside, which can slow down the economy. So for the public, it's generally bad news in the longer run. It puts pressure on the household and also limits what government can do to help when the times get tough. Now, at the federal level, the debt to GDP ratio is projected to decline slightly from 42.1% in 2023-2024 to about 39.2% by 2029-2030. But that's if no large spending measures are introduced and many temporary measures expires. Now, let's talk about the deficit trend in this one. For 2024-2025, the deficit is expected to be about 50.1 billion, that is roughly about 1.6% of GDP. By 2029-2030, projected to fall to 24.6 billion, that is roughly about 0.7% of GDP, under assumption that the status quo remains the same. Now, at 1.6% of GDP and declining, Canada's deficit remains small as compared to other G7 countries like United States. It does have a 7.6% in 2024 and United Kingdom at 4.3% in 2024. We are at 1.6, so that's a really good news for Canadians. The other one is the household debt. It's very high as of right now. According to OECD, as of Q4 of 2024, the household debt in Canada is just over 171% of disposable incomes, among the highest in the OECD. So when the debt goes up, servicing cost goes up and deficit still remains present. But Canada isn't yet in the default territory. Many of these numbers are high, but some projections suggest stability if nothing or no drastic change happens in the country or even geopolitical side. Now, do Canada current trend matches with the warning sign of Dalio's what described in the book, and where is the Canada vulnerable? So let's check this out. Very first one in this one is the excessive borrowing. So if you see over here, yes, both government and household are borrowing heavily, and government debt rising. Many provinces are running in deficit. So household carry higher mortgages and credit obligation in this one. Now let's check out how serious this is or the risk factor in this one. So this one for the excessive borrowing, the risk is that the interest rate rise further and it squeezes like the inflation squeezes income and then provincial debt may have a weaker revenue basis as well. The second factor in this one is the debt service burden higher relative to revenue or the income. So again, this factor it is rising for Canada. Public debt charges are increasing. Debt to service ratio, that is public debt versus the total revenue, is projected to rise on this one. That is something what we have seen in the parliamentary budget. Now, what happens if this rate rises more sharply or revenue drops? This could become unsustainable, and provinces often face tighter constraint in this one. The third factor in this one is the slowing growth or the productivity loss. So basically, we have a mixed review in this one. Canada has resources advantages, but the risk is the higher cost of housing, regulatory barriers, and the climate transition, global trade pressure. Now, productive growth has been sluggish. If you are seeing all this news, all these reports outside, we know in terms of productivity, it's not adding up. It's only because we have added more number of people into the country. That's why the productivity chart or the map, whatever you're seeing, it's on the higher side. But if you compare to per capita or productivity per people, it's not at all high. Now, what this could do, so if the growth slows or any negative shock hits like commodity crashes or global slowdown, the ability to grow out of that, it weakens. It's very hard to grow out of it. The fourth in this one is the monetary or the fiscal policy strength. Now, there are some signs that we are seeing is that inflation, increased public spending, pressure on federal and provincial budget, but Canada still has good credit and ability to borrow domestic. And the major risk if borrowing costs spike or if external debt becomes significant, it also risks for an inflation induced cost that is like index payments, pensions, etc. And the last on the list is the confidence or the external shock. So again, this there is no way to measure the confidence in this one. There is no metric or anything like that. It's just a general poll, but that's why it's less clear on this one. So Canada still has a strong institution, I would say, does have a stable political environment compared to what you see in the world out there. And but the external shock, it's always possible. So if you don't know what will happen in this one, yeah. But this is something to add. If the confidence erodes, the bond market demand higher yields, foreign investor pull back, and things could worsen. This is something we have seen in the past. So to summarize this one, Canada exhibits many of the early to medium warning signs, but there are also buffers like solid institution, ability to borrow in its own currency, relatively moderate deficit compared to percentage of GDP when you're comparing to other countries, and the projection that the under status quo, the debt burden might moderate. And the big question in this one, what if the status quo does not hold? So let's check out what could push Canada over that. If certain negative factor aligns, Canada could enter a crisis. Here are the possible triggers or scenarios based on what is happening right now. The very first one in this one is the interest rate shock. If global rates go up steeply or Canada loses the credibility and must pay at a much higher yield. Now, debt service in this one will skyrocket. The second one in this one is the economic growth slump. Now, recession, a collapse in commodity prices, or a global trade disruption reduces revenue. It also slows growth. The third in this one is the provincial debt stress. Now, some provinces with lower revenue, higher social spending, weaker economics hit tougher times. If one or more provinces face default risk, it could strain the federal government or spill over. Fourth in this one is the inflation or the currency stress. If inflation spikes or if the Canadian dollar loses value, import cost, index payment rises, also pressures on household already carrying higher debt. This will affect almost most of the Canadian out there with the mortgage. Fifth in this one is the loss of confidence or the investor flight. Basically, if creditor demands higher yield or if the rating agency is downgraded, that could forces government to pay more and limit the ability to borrow. Now, here are the some of the worst case outcome or worst case scenarios. The very first one is the serious downgrades, higher inflation, higher interest burden consuming large share of revenue, cuts to social programs, and possibly debt restructuring as well. The best case scenario in this one would be prudent policies, moderate growth, deficit shrinks, which we have seen right now, debt service remains manageable, and the incremental reforms like taxes, spending control, and the controlled inflation, which is a very necessary for. Now, what you need to watch as a normal public as a Canadian. So if you're wondering, can Canada go broke like some other countries in Dalio stories? The answer is not soon. But there is a real risk in this one if the warning sign is ignored. And here are what to watch and what must be done. So here are a couple of watch indicators as a normal public you should take care. The very first one in this one is the debt to GDP ratio, and both federal plus provincial. The second on the list is debt service ratio, that is the interest payment in revenues. The third to look at the household debt burdens and delinquency rate. I'll be making a delinquency rate video soon, both for businesses and also for households. So make sure to subscribe to the channel. Fourth in this one is the growth versus inflation versus interest rate trends. And the other factors could be like credit rating changes, like bond yield, investor sentiments, and so on. So if Canada does this well, it can avoid the darker Dalio scenarios. But doing nothing or doubling down on deficit spending without regards to the debt service leaves the door open. Now, Canada has many strengths. The very first one is the stable institution, a diversified economy, ability to borrow on its own currency. But Ray Dalio's lessons remind us that strength doesn't guarantee immunity. The early signs are visible in this one, particularly in the rising debt, increasing interest burden in this one, growing household leverage. But we are not there yet. Going broke in Dalio scenarios require a tipping point. So that is a rising debt service, falling growth, or loss of confidence in this. Those signs are coming closer than many of us realize it. Thank you so much for watching and don't forget to subscribe. I will see you on the next video.